Hello, my name is Will Hoffman, President and founder of Hoffman Wealth Management. Today we're going to present to you the annual outlook from LPL Research titled A Turning Point. If you have any questions about anything that you hear here or see anything that you don't quite understand, please feel free to reach out to our office at 724-522-5411 or to connect with us through our website at hoffmanwealth.com. When it comes to the overall economy in 2024, LPL Research is expecting a slowdown. We do believe a recession is likely to emerge in 2024 as consumers, under increasing debt burdens, deplete their excess savings and are no longer able to keep up with debt payments. Leading indicators that we're watching include an increase in serious delinquencies in credit cards and auto loans. We expect the spending splurge to end, with consumers reverting to trend in 2024. The consumer will no longer be willing to spend as they did in 2023. We expect to see a Federal Reserve focus less on inflation and more on the other part of their dual mandate, stable growth. As already highlighted, inflation will still hover above the 2% long-run target and remain a concern, but the Fed will likely be less laser-focused given that the trajectory is going in the right direction. When it comes to the job market, some call the recent shift in favor of the average worker the democratization of the workforce, considering that workers have rarely had this much bargaining power. As the American worker has had a few years to adjust to the hybrid work model, we should continue to see a fair amount of turnover. Some have seen the fastest way to higher pay is moving to a new job. Of course, the hybrid model can only operate in some sectors, so its impact varies depending on the industry. LPL Research forecasts for economic growth and consumer inflation across regions in 2024. Here are LPL Research's outlook for stocks and following the cycles. As the next 12 months of the bull gets underway, market history tells us solid gains may lie ahead. Of the 12 such periods since 1950, the S&P 500 has gained an average of 12.6% and was positive every time. A gain of this magnitude seems reasonable given the potential for support from the Fed as inflation falls. With inflation still elevated, high rates remain a threat to the economy and the stock market. Stock and bond yields became increasingly negatively correlated, moving in opposite directions in 2023. While that wasn't great news for the stock market, it does mean interest rates could present an opportunity, as LPL Research believes the 10-year Treasury yield could be less volatile in 2024. Our 2024 S&P earnings per share forecast is $235 per share, up from our prior estimate of $230. The new estimate represents only about 7% earnings growth from the current 2023 consensus S&P EPS estimate of $219. Beyond economic growth, how companies manage waning pricing power as inflation falls is key to the earnings outlook. Reversals of 2023 earning declines by the healthcare and natural resource sectors, along with increased earnings growth in the technology sector, will help drive a turnaround in overall earnings. Stock valuations are high by most measures. The price-to-earnings ratio, or PE ratio, based on the consensus S&P 500 earnings per share estimate for the next 12 months is 18.8, above the long-term averages in the 15 to 16 range. Factoring in interest rates allows for a more complete valuation assessment, as a stock's fundamental value is derived from the present value of future earnings. Plus, yields from bonds provide competition for stocks. Comparing the earnings yield for equities, which is earnings divided by price, to the yields on bonds using the 10-year Treasury, we arrive at an equity risk premium for the S&P 500 near zero, suggesting equities are fairly valued. While earnings growth will likely help push stocks higher in 2024, the contribution from valuations may be more limited. Stocks appreciate in value primarily in two ways: either earnings grow or valuations become richer. The good news is that stocks can move higher in the coming year without much help from valuations. A different story from the past 2 years. A price-to-earnings ratio of 19.5, in line with the 5-year average, represents only a slight improvement in valuations from the 18.8 level in mid-November. Based on a PE ratio of 19.5 times our projected 2025 S&P 500 earnings per share of $250, we estimate a fair value range for the S&P 500 at the end of 2024 to between 4,850 and 4,950. This suggests potential high single-digit gains at the midpoint. When it comes to fixed income and bonds, we are talking about being back to normal. With the economic data so far continuing to reflect a more resilient economy than originally expected, we think Treasury yields are likely going to stay higher for longer as well. As such, we think the 10-year Treasury yield could stay in the 3.75 and 4.25% range, with risks roughly balanced. However, while we think the economic data softens in 2024, which should allow the Fed to gradually adjust monetary policy lower, we can't entirely rule out two other scenarios either: traditional recession or a re-accelerating economic environment. How much higher could rates go? Looking at interest rates over a longer time horizon provides perhaps a bit more clarity on what could be considered normal for interest rates. Data since 1880 shows that interest rates were in a fairly tight range before the spike in interest rates that took the 10-year Treasury yield to those very lofty levels in the 1980s. In fact, long-term rates mostly traded within a 3% to 5% range for nearly a century before moving aggressively higher as the Fed fought those generationally high inflationary pressures. Periods outside of that 3% to 5% range have resulted from the economy's growth and inflation dynamics, which ultimately shapes the Fed's interest rate policy. So the sharp increase in the 10-year yield over the past few years puts the yield firmly back into the normal historical range. The corporate credit markets have been resilient so far in this cycle, with credit spreads, or the additional compensation for owning risky debt, remaining below historical averages. However, with the increase in Treasury yields over the past few years, corporate interest payments are set to increase as well. And while the health of the corporate landscape is generally positive, rating agencies are starting to adjust their outlooks based upon, among other things, the expected increase in debt payments. The ratings environment remains relatively calm for companies across investment grade. However, lower-rated companies have taken the brunt of downgrades and will likely continue to in the coming quarters. Year to date, S&P has downgraded its outlook and the outright rating on 814 companies, both investment grade and high yield, versus only 512 upgrades, which makes 2023 already the worst year for downgrades since 2020. When it comes to geopolitics, we're already talking about an increasingly complicated landscape. Commodity prices have been easing lower as the global economic landscape, particularly as China's slowing economic recovery, continues to soften. The dollar is stronger compared to foreign currencies because of favorable interest rates, but is overvalued compared to the yen, euro, and BP. Capital is flowing back into the U.S. accordingly. The yen is weakest because Bank of Japan hasn't acted. The U.S. dollar is clearly very expensive on a historical and relative basis, and there is going to be value in holding foreign-denominated assets in the longer term. This will make sense soon to own foreign assets on an unhedged basis. Until we see a persistent shift towards synchronized global growth and central bank tightening, example, not U.S.-led, foreign currencies as a whole will likely struggle to meaningfully outpace the dollar. When it comes to alternative investments, embracing agility in a volatile market will be very important in 2024. We expect greater dispersion and volatility brought by the continued decoupling of global economy and policy actions, while anticipated slowdown in economic activities and rise in geopolitical risks, as well as political events like the U.S. presidential election. Recommended strategies can generate alpha from both top-down macro as well as bottom-up fundamental dispersion, have limited beta, and benefit from the rise in volatility. We remain constructive on global macro strategy that could capitalize on the macro dispersion across the regions and tends to benefit from the rise in volatility. Managed futures should help with portfolio diversification as well. We have grown more positive on bottom-up fundamental-driven strategies that carry low beta, especially low net and market-neutral stock pickers who can benefit from greater dispersion. We are seeing between high-quality companies versus lower-quality cash-tight companies. Among private market strategies, we expect private credit and infrastructure to continue to show their resilience as both strategies have secular tailwind at play. We are positive on secondary markets as well. Private credit, bigger market share, and attractive yield. Recommend staying in high-quality assets as we cautiously monitor the pickup in distressed default rates. When it comes to infrastructure, one of the key areas that will continue to benefit from the secular trend of global digitalization, decarbonization efforts we see across the countries, and Build Back Better Act in the U.S. In secondary markets, they lend at compelling opportunities for managers, more general partners, and limited partners turning to secondary markets to meet their liquidity needs and take on assets at an attractive valuation. Thank you for tuning in to the 2024 Annual Outlook provided by LPL Research. If you have any questions, please feel free to reach out to us through our website at hoffmanwealth.com or simply give our office a call at 724-522-5411.